So before we get going, any questions on anything previously? Chapter 3, 2, 1, anything we covered yes Tuesday or anything like that? Okay. I did want to ask you guys one question, and I'm not sure if I'm going to do this. I'm debating. Um, I'm thinking about maybe looking to see if our classroom's still available over in the student union, and maybe next week or the first of April going back to in person. What do you guys think about that? Don't all jump at once. Julia's like, yeah, whatever. At this point, doesn't matter. And that's what I've been debating too. I don't even know if the classroom's still available because I think I was the only one. I think I was the only one who used it last semester, and I haven't used it this semester. So they may have taken it down, but we'll see. I'll probably go over there Monday and see if it's still put together and all that because it was in the grandfather ballroom there. Looks like we're going to only have a few folks today. Wow. So we were talking about the ratios Tuesday. Any questions on the ratios we talked about? We talked about the first three groups. So short-term solvency, long-term solvency, and excuse me, folks, I'm sorry, and the asset management. Any questions on any of those groups of ratios? Everybody's good. Okay. So we'll pick up today, and like I said, we'll only have a few minutes of lecture. We'll do some of the problems and get on out of here for the weekend then, okay? So let's look at the next group. The next group is group 4, our profitability ratios, okay? So the first one we look at is profit margin. And profit margin's net income over sales, right? Now, notice in the asset management, we talked about it was sales over pretty much all these things: fixed assets, total assets, net working capital, and sales with inventory and accounts receivable, right? With the profitability margins, we go from sales to dealing with net income. James, you peeking in on us? You're not sure?
Yeah, I got to run out to my car. I just got off a phone call. I got to run out to my car and get something to send to this guy real quick.
Yeah, go ahead.
All right, thanks.
So now we're dealing with net income. So again, profit margin is net income over sales. What does that tell us about the company? All this really tells us is what type of company do we have, right? It tells us, do we have a low margin, high volume business, or a high volume or a high margin, lower volume business? Profit margin really doesn't tell us if we're making money or not. What it does tell us though is how much of each dollar of sales is falling through the system and actually getting into our pocket. Okay, that's what we get with profit margin. Okay. The next one you see is return on assets. So here it's net income over total assets. In the previous group, we had total asset turnover, which was sales over total assets. So how good were those assets at generating sales? With return on asset, we're looking at how good are those assets at generating net income. Okay. So a little different perspective there. And then probably the biggest one that we're looking at here is return on equity. Why would this one be such an important ratio to look at? What's equity again? Equity is ownership, right? So this is the return on our ownership. So it's net income over total equity. So basically what we're looking at here is for every dollar we put into the company, how much are we getting back? Okay. Now, a couple things. when we look at this, if we look at this number, we look at this ratio, and we're like, hey, we're not happy with that number. Okay, I'm not happy with the return I'm getting on my investment, basically. Then where do we go to try to correct that? So what another way to calculate return on equity is what they call the DuPont equation. Okay. So that's the next equation there. You see the return on equity. If we blow this up a little bit, we see return on equity is net income over sales, right? And we've seen that before. That's our profit margin. We also see it's sales over total assets. We've seen that one before in the previous group of ratios. That's our total asset turnover. And then we see total assets over total equity, our equity multiplier. So with return on equity, using this DuPont equation, if we look at it, profit margin gives us an idea of our operating efficiency. Okay. Total asset turnover is asset management. Do we have that machine that's maybe out of tolerance? You know, it's old machine, so it's been worn in, and maybe now it's not within the tolerances that we need for our product, and we're having to throw out product because we have defective inventory. Okay, so maybe we need to replace that machinery. And then the last one there, total assets over total equity, that gets into our financing. So with the DuPont equation, we're able to get into our company on 3 different ops, asset management, and financing. Okay, and we can use that to dive into our company and see what area we might need to make some adjustments to improve the return on our investment. Okay. Also, if you look at it, notice with the first 2 parts there, net income over sales and sales over total assets, the sales cancel out and we end up with net income over total assets. Well, that's our return on assets. So return on equity basically is just return on assets times our equity multiplier. Does that make sense? Is everybody good there? Okay. You guys know I like to give you a visual representation. So if you have your books, look at page 72. If not, put this in your notes and make sure you look at this figure. Okay. What figure 3.1 gives us, it's an extended DuPont chart for this DuPont equation. It basically shows you how you can use this equation. And James, this might be interesting for you down the road, how we can use this equation to get down and penetrate into our company. What part is not getting us the returns or the results that we want? Okay. And so you can see how this equation will penetrate your company and do that. By the way, James, hey, after we're done, tell me how your meeting went. I want to know how the follow-up went afterwards. So, all right. So is everybody good there? Is everybody good on the profitability ratios? So with return on equity, why is that one? Why did I say that one's probably the most important? Who's interested in that?
Investors.
The owners of the company, right? I mean, if you're putting the money in, you want to make sure you're getting a good return on that equity, on that investment. Okay. So this is your shareholders, your stockholders are interested in this number. Okay. Because they own the company. All right. Everybody good? Any questions on any of that? Now, folks, I will tell you this. You need to know this DuPont equation inside and out, upside down, backwards. Make sure you study that equation and understand what you can do with it, okay? All right, let's look at the last group. And quite honestly, I'm not going to spend a whole lot of time on the last group of ratios, namely because you'll get some of this if you get into survey of investments and derivatives. That's where you'll really dive into these and analyze it. The main 2, I'm only going to look really at 2. The first one is the price to earnings ratio, or what we call PE ratio. Okay. Sorry about my writing there. That is price per share over earnings per share. Okay. And we calculated earnings per share in a previous chapter, in a previous problem. You remember, how do we get earnings per share?
Take net income and divide it by The outstanding shares.
Exactly. So net income divided by the number of shares gives us earnings per share. When we look at PE ratio, price per share over earnings per share, what this ratio is giving us is how much am I willing to pay for each dollar of return I'm getting from the company? Okay. Now, what you see a lot of, maybe not as much anymore, but back in the 70s, 80s, early 90s, people would trade and invest in companies based on the PE ratio. And if we had a PE of 17 to 22, that was considered generally a good range, okay? If it was below 17, people were like, people don't believe in the company, not investing. Or if it was above 22, people were like, wow, they really have some big ideas for that company and feel really strongly about it. Folks, that is not the way to trade or invest, you know? Back then, the conversation would be like, hey, Julie, I just invested in XYZ company. They got a PE ratio of 18 and everybody ought to get into it. And great, what's PE ratio mean? I don't know, but everybody says that's where you want to be, right? That is not the way to invest, folks. You got to understand what's going on with the company, okay? And you know, what's the growth, what's their product, what are their plans for the future? All of that should be involved in your investing strategy, just not what a PE is or what net income is or whatever. That's just like in the previous class, a student was asking me about Tesla. And I can't remember if it was this class or one of the others. We talked about Tesla before. Most of Tesla's income comes from selling gas credits to other companies. It doesn't come from selling Tesla cars. So as other companies develop electric vehicles, they aren't going to need those gas credits from Tesla. So what's going to happen to Tesla's income? It's going to go down. Yeah, there you go, Julie. It's going to go down, right? So I know we're all up on Tesla right now because, hey, they got the best battery situation right now. But Volkswagen, you know, what's that company in China? NIO? Is it NIO? Anybody heard of that one? It's basically like Tesla in China. I think it's called NIO. They are right on the heels of Tesla. So as these companies catch up, that's a lot of that might just go away, you know? So we'll see what happens. I'm not knocking Tesla. By all means, don't think I'm not knocking Tesla. I'm just trying to get you to understand. Make sure you're looking at what's going on and where's the company getting their money from, right? If you listen to the media, Tesla gets all their money from selling their cars. It's actually very small, like 730 million or $740 million of their profit is from selling cars. The rest of it's from selling the gas credits to other auto manufacturers. That's the big chunk of their income, okay? And again, please, I'm not knocking Tesla. I'm just making, I didn't even know that. I just happened to come across that article and I read that and I was like, holy cow, you know, you don't hear that about that company. But anyway. All right, let's move on. The other ratio is the PEG ratio, and all this is the PE ratio to growth. So you look at the PE ratio times their earnings growth rate or the growth rate of the company, okay? Quite honestly, folks, that's about the only two things I want you to know about the market ratios, market value ratios. Like I said, the others you're going to get into more with survey of investments and derivatives. All right, any questions so far? Everybody good? Okay. Did you guys look at the problems? Anybody have a chance to dive into the problems? James wasn't. I know he was busy. Julia did. A couple of the others did. Good, good, good. So what we'll do is we'll look at some of these problems. I don't want to do all of them because I want, if you didn't do them, that I get it. We'll dive into some of them, kind of, you know, grease the tracks for you, get you started on it, and then you'll finish them up for Tuesday, okay? So let's look at the problems, and we'll jump. I think I had you do 1 through 5 and then 7 and 9 or something like that. So let's take a look at, let's see, we're on page 85 here. Let's look at problem number 1. So SDI has net working capital of 2170, okay? Current liabilities of 4590 and inventory of 3860. They want to know, what is the current ratio? Okay, current ratio we know is current assets over current liabilities. So we have current liabilities 4590. Ooh, that's bad. Let me correct that 5 there. 4590. What about current assets? We don't have that number.
Yeah, you have to add the current liabilities and net working capital.
There you go, Matt. So we know net working capital is current assets minus current liabilities. So we have 2170 minus 4590. So current assets, what did you get there, Matt?
6760.
Okay. So that means our current ratio is what?
1.47 times.
Okay. So what is that telling me, guys?
That with your assets that you currently have, you could pay off your liabilities that many times.
Okay. So as a creditor or a supplier, are you worried about getting paid? Julia's shaking her head no. No, we're not worried about getting paid, right? Okay, then it asks us for what is our quick ratio? So if we look at the quick ratio, we know that's current assets minus inventory over current liabilities. So we have 6760 minus the 3860 over 4590. And what do we get on that one?
.63.
There you go, Lewis, 0.63 times. Okay, now looking at these two ratios, tell me about this company. What's going on here?
They got a lot of inventory.
A lot of inventory, okay. What else?
It's saying that they're pretty liquid if they're able to move their inventory. If not,
Yeah,
then they're not exactly liquid.
yeah, so Julia said they have a lot of inventory, right? James, so a couple of things. Maybe this is like a grocery store. It's inventory that they can sell fast, right? But it also tells me they're very dependent on selling that inventory to make sure their bills are covered. So as a supplier, okay, great. Hope you know your customers, right? I know what type of business they're in, but I also know if they don't sell what I'm selling to them, they aren't going to pay me. Okay.
Probably want to look at their inventory turnover at this point, wouldn't you?
Yeah, you probably want to look at their inventory turnover, see what's happening there. Just from seeing this though, and like Julie said, hey, they carry a lot of inventory. You got to have the thought is they probably have a high inventory turnover ratio. And that's where getting what James said, hey, let's look at that inventory turnover. If they have that high inventory, but their turnover ratio isn't that high, maybe I want to be cautious if I'm going to sell to this company. Okay. Is everybody good? Does that make sense? Do you see how you're reading the numbers and all? You guys are doing a great job. Good job. Good job. All right. Let's look at the second one then. So looking at profitability ratios. So on number 2, we have sales of 16.7 million. Okay. We have total assets of 12.9 million and total debt of 5.7 million. Okay. If the profit margin is 5%, whoops, sorry, let me correct that. Let me fix this D, that looks like a P, so total debt, a profit margin of 5%, okay? They want to know, what is net income? So how are we going to get net income here? We know profit margin equals net income over sales, right? So we know 0.05 equals net income over 12.9 million. So then net income equals 0.05 times 12,900,000. So net income then is how much?
835,000.
Okay, 835,000. Does that, think about that. You did almost 13 million in sales and let you get to keep less than $1 million. Kind of crazy, isn't it?
Why are you using the 12.9 instead of the 16.7?
Oh, I'm sorry. Thank you.
Sorry, I didn't know if I was messing up or.
No, I looked at the wrong number, Evan. That's why. Thank you for calling that out. I don't know why I did that. I had the 12 million stuck in my head for some reason for the assets. But Matt gave us the right number. This should be, and thank you, Evan. I appreciate it. I'm sorry. So you did almost 17 million. Okay. Evan, thank you for pointing that out.
No problem.
I just had a little mental block there, but this number is correct, right, Matt?
Yes, that I didn't notice that you used the wrong number, but that's what I got for 16.7.
Okay, good. Whew, thank you. Sorry about that. I apologize, guys. My fault. I'm sorry. Okay. I think I had 12 million on my mind because that's what we use for the next couple of equations. And again, I apologize. All right, so let's look at this. So the next part says, so that's the net income. What is ROA? Okay, ROA is net income over total assets. So we got 835. Okay, Evan, I used the right number here, right? 12.9 million.
Yep.
Thank you. All right, so what's our ROA?
$6.47%.
Okay, 6.47% return on assets. Now, what is that number telling me again? For every dollar in assets that I have, right? So Noah, like your trucks and compressors and all that stuff, crane, I don't know if you have cranes or you just rent those out if you need them or what, but for every dollar in assets that you have, those assets are generating 6.5 cents of net income. Okay. And then it asks us for ROE. Okay. So net income over total equity. Okay. So we got the 835. How do I get total equity? I got to go back to my equation of total assets equals total debt plus total equity, right? So my total assets, what do I have up here? I have assets of $12.9 million. I have debt of 5.7 million plus total equity, right? So total equity then equals, what is that, 7.2 million? So what's my return on equity here?
$11.6.
11.6%. Okay. Does that make sense? Everybody good there? So what is that number? What is this number telling me?
For every dollar that you put in the net income, you get 11.6% of it goes to ownership.
Exactly. Very good, Julie. For every dollar that you put in as an owner, you're getting 12 cents back. Or 11 and a half cents, 12 if you want to round it. Okay. Everybody good? All right. And you see, folks, that I think I mentioned this earlier, you will have everything you need to solve the problem, but you may have to, work a different equation to get a number to plug into the equation that you need. Okay. So as we go through the homework and as you look and think about what might be coming up on the exam, understand you might have this same situation. I need to get this equation to solve for this number to go put in this equation to get the ultimate answer that I'm looking for. Okay. So just be aware of that and kind of be thinking about that as we go through these other problems. Was that 2? Okay. So now we're at 3, calculating average collection period. So this company has a current accounts receivable at 537,810. Okay. They have credit sales for the year of 5,473,640. Evan, make sure I'm getting the right numbers and using the right numbers here. Okay, they want to know, what is our receivable turnover? Okay, all I need to do is divide that. So what do I get for my receivable turnover?
10.18.
Okay, what does that mean? What does that mean? Julie, you just muted yourself if you were talking.
I thought I had the answer, but then I second guessed myself.
No, well, you never know. Give it a try. Let's see what you got.
So I don't know if it's throughout the year, but throughout whatever period these numbers are, you're replenishing your entire inventory 10.18 times over.
Yes. Yeah, well, this is collections. This is our collection. So what, Julie, you're right. What we're doing during the course of the year, we're loaning money out and we're collecting it all 10 times. Okay. So not even once a month, right? So then the next one says, well, what's your days sales in receivable? Okay. So if we look at days in receivable, we take 365 divided by the 10.18 and we get how many days?
35.8, so 36.
Okay, 35.8 or 36 days. So Julie, what that tells you is every 36 days you're collecting on your money. Is that good or bad?
I would say that's pretty good.
It kind of depends on the company, right? But remember, whose money do we want to use to run our business?
Someone else's.
Someone else's. If we're not collecting, but every 36 days, generally we have to pay our bills at least once a month, right? So whose money are we using to run our business in that case?
Our own.
We're using our own. So we might want to look at this and figure out how can we collect it sooner, right? So what might be some things that we do?
Change our days to pay to maybe 15 or 30 flat.
Okay. But how are we going to do that, James?
Negotiate different contracts for the people buying our stuff.
Different contracts or try to incentivize people to pay us early, right? Because James, just because we have that contract doesn't mean I'm paying you in that time, right? So that's where we got to look at, maybe we incentivize, and if that doesn't work, maybe we need to cut some people loose. What if we cut customers loose though, what's going to happen?
That
So-
number's going to go up.
Our turnover time our inventory turnover might go down, right? Is that necessarily a bad thing? I don't, hey, we're turning it less times, but we're collecting the money faster. So now we have the money to operate our business. Maybe that's not a bad trade-off. You just gotta, it's gonna be that balance and you gotta find that balance for your company. Make sense? Okay. All right. Let's see. Okay, so that was 3. Now let's take a look at 4. 4 is along similar lines. We're talking about inventory turns here. So they have inventory of 386,735. Okay. We have a cost of goods sold of 4,981,315. Okay, and we're looking for inventory turns. Okay, so we're just going to divide that. That's going to give us times here. How many times are we turning over our inventory?
12.88.
12.88, almost 13 times. So less than one a month. Once a month, we're turning over our inventory, right? Okay. Same question. They say, what's days sales and inventory? So we take 365 divided by 13, and how many days?
28 days.
Every 28 days, okay, we're turning over our inventory. Good or bad? If it's a grocery store, that's probably not too good. If you're the Tractor Supply place on 421, that's awesome, right? So we'd have to know what the business is to see if that number is good or bad. Okay. Could we affect that number some more?
If we drove our costs down, we could, increase the times, wouldn't we?
Yeah, if we drove costs down, we could do that. And that's where our the supply chain folks come into play, right? 2 things you can do. You can either reduce costs or increase sales. And it's 4 times easier to reduce costs and increase sales. Just from what studies show, right? So the other thing we could do is maybe we start loosening our credit restrictions, right? Bring on more customers, let them buy on credit, but that might tie into what we did in problem 3. Now we're extending our credit collection days out there and things like that, right?
Also,
So-
maybe employ a just-in-time inventory replenishment.
Yeah. Yeah, you could do the just-in-time stuff and all that. And that's important because we didn't talk, I can't remember if we talked about this in this class or not, but what's one of the biggest expenses of a company?
The cost of the goods sold.
The cost, right? One is employees. The other expense, when we talk about day sales and inventory, if we have a lot of day sales and inventory, what do we have to do with all that inventory?
You have to store it.
We have to store it. That warehouse or storage space, either we have to have a big warehouse or we have to have a really big store with a lot of shelving, right? That costs money. That's probably the second biggest expense, right? So just like James would say, hey, if we go just in time, we don't have to have all the storage space. We can cut our costs down. Now we're carrying fewer items on the shelf. And if we sell one and get one in, we can turn that and keep our inventory turns up without having to carry as much on inventory. Does that make sense? Okay. Good. All right, let's take a look at another one here. Let's look at number 5. Okay. How did this one go? Okay, if we look at number 5, Queen Inc. has a total debt ratio of 0.46. Okay. They want to know what is debt to equity and what is our equity multiplier. And that's all you've got. So where do we go from here?
I was confused on this one, but what I did was I took the 0.46, and since debt plus equity would equal 1, I just said equity was 0.54.
Okay. So you went to this equation, right, Matt?
Yes.
Whoops, total equity, and we have debt of 4.6 plus 5.4. And that's exactly what you have to do, right? So 0.46 to 0.54. So what's your debt to equity ratio there?
0.8518.
8518. So what does that tell us?
That debt would be 85%. Nah.
No, look at the ratio, debt to equity. Julie, go ahead.
You have more equity than you do have debt.
Yes, we have more equity than we have debt, right? If we look at it let's make it as simple as possible. For every dollar that we put into our company, for every dollar Noah
85%
puts into his company to buy a house, he's borrowing 85 cents to go with that. Okay. So then we get to our equity multiplier. And remember, equity multiplier is total assets over total equity. Okay. So we can do 1 over 0.54. What's the other way we do that?
Just add 1 to your debt equity ratio.
Debt to equity plus 1, right? So our equity multiplier is 1.8518, right? Okay. So by going out and getting that 85 cents in debt, we take and we put that with our dollar. Now we put those two together. By getting that debt, I turn my $1 of equity or investment into $1.85 in assets. Okay. Is everybody good there? All right.
I'm sorry, could you repeat that last bit of information one more time?
As far as what it means for you, Lewis,
Yeah.
for every dollar, like if this is Noah's company, right? Noah's family buys houses, fixes them up, and flips the houses, right, Noah? Is that right?
That's
Okay.
correct.
Okay. So what that means is, Lewis, for every dollar that Noah's family puts into a project, they're going to borrow 85 cents. Okay. So let's keep the math real easy. So if they put $100,000 into a house, and I know this isn't happening, you don't spend that kind of money on those houses, but if they put 100,000 in, they're borrowing 85,000. So then they can buy a house worth $185,000. Then they can go fix it up and hopefully sell that house for 285 or 3, because they're going to put a bunch of money into it to get it to that point.
Got it. So the debt to equity ratio is telling you how much you have in total to use.
Well, the debt to equity is how much did Noah put in versus how much they borrowed. So for every dollar that they put into the company, they borrowed 85 cents. Okay. And then the equity multiplier is saying by borrowing that 85 cents, it took their $1 of assets that they put into the company, or $1 that they invested into the company, they got the 85 cents in debt. So by doing that, the equity multiplier says, hey, getting debt turned that $1 into $1.85. Or in the case of like we were talking about with the house, they put 100,000 in, they borrowed 85. So they put 100,000 in, but they could borrow, or they could buy a $185,000 house to go fix up and sell.
Got it. Thank you.
Yes, sir. Okay, everybody good? All right, let's go to number 7. I think I said 7 and 9, but let's look at 7. 7, we're using DuPont identity, right? So remember that equation. What's the DuPont identity again? Net income over sales times sales over total assets times total assets over total equity. That's the whole equation, right? We know that this is the equity multiplier, total asset turnover, profit margin. Okay. So they have an equity multiplier of 1.27. So Lewis, what does that mean? The equity multiplier of 1.27.
How much money they have in total to spend for with what they're borrowing.
How much they have in total asset. Okay. So they put $1 in, they added debt to it. They have $127 in assets. Okay. They have a total asset turnover of 210, right? So every dollar in assets here is generating $2.10 in sales. So like for Noah's family, the trucks and all the tools they've invested in, every dollar they have invested in the equipment and the tools they have turns into a $2.10 in sales. Now they don't get to keep all 210, but that's the sales they get that it generates. And they have a profit margin of 61%. So they want to know what is return on equity here. So what is the return on the equity?
16.27.
Yeah. Okay, there we go. Is everybody good there? So for every dollar that Noah's putting into his family's putting into the company, they're getting 16 cents back. Does that make sense, Lewis?
Yep.
Okay, good, good. That's about as far as I got with the first class. I don't want to get too far apart with the classes. I want to try to keep everybody together. So what I want you guys to do, finish out the problems. We'll finish these Tuesday. The other reason I don't want to go do too many problems is if hopefully Tuesday, we'll spend all Tuesday on the problems. If not, then we're going to start getting into chapter 4. Okay. So we'll see what happens. So for Tuesday, just finish these problems out. If we get started into chapter 4, I'll put the quiz off till Thursday for you. I'm not too worried about that. Okay. Focus on these. Go enjoy your weekend. It's going to rain.